Hi, everyone, and thanks for joining the webinar today. We're going to be talking about the reporting of disposal of UK residential property. This is an area where a new bit of legislation which came in, it's been in effect for over a year now, but it's kind of slipped under the radar and not many clients are actually aware of the changes. So the purpose of the webinar is actually to go through what those rule changes are, who's affected by those changes, and what kind of steps those people, individuals would need to take to safeguard themselves for future. So that's me, Balder Healy. I'm one of the partners here at RDP Newmans. Okay, so before we get onto the changes themselves, just discuss a bit about how the rules were previously. Now, whether you're a UK resident or not, if there was a disposal of residential UK property, then that disposal would be recorded and filed with HMRC via that individual self-assessment tax return. So regardless of whether they were disposing of one property or 10 properties in that tax year, all those disposals will be recorded in an individual self-assessment tax return. Along with, if there's, regardless of whether that property you made a loss or not on that property, either a capital loss or a capital gain, that would also be recorded in the self-assessment tax return. Now, as it says there, the deadline for paying is the following 31st of January after the end of that tax year. So for example, where we have a UK residential property sold by an individual with a gain of £50,000 on the 1st of January 2018, that would fall in the 17-18 tax year. That would then need to be reported on that individual's tax return by the following 31st of January 2019, right? So it's worth noting here that from the initial disposal on the 1st of January 2018, there's nothing need to be reported or indeed any tax paid until almost 13 months later. So the changes which have come into effect, firstly, if we talk about UK residents, is that you're fundamentally still paying the same amount of tax. So that hasn't changed. So the way that the computation is done, the way the capital gain is worked out, even the rates at which you're paying the capital gains on, that still stays the same. What has actually changed is that you now need to report any disposals where there is any tax to pay. You need to report those disposals within 30 days of completion or sales completion of that disposal, and any tax which is due has also got to be paid within 30 days. So whereas previously we had this 13-month gap, could be maybe longer, now that's shrunk down to 30 days. Okay. Now that doesn't matter if you're, it applies to each property on which you are disposing of in the year where there's a tax liability to pay. So for example, in the previous, what we previously mentioned, whereby you could dispose of 10 properties before and only report them on the self-assessment tax return. Now, for each and every disposal, for whichever those disposals trigger a tax liability, each of those would then need to be reported to HMRC individually. So you could end up filing 10 capital gains tax returns in the year. What hasn't gone away is you still need to report that through your self-assessment as well. So that's still there. So this new legislation which has come in place is over and above what was there previously. Okay. Now I mentioned there that there may not be tax to pay, and if there isn't any tax to pay, then there does need to be a capital gains return filed. Now that can occur in pretty much one of two scenarios. The first being that the gain which you've realized on the disposal of the property comes to under the annual exemption amount of 12,300. Or if the property which is sold was the individual's main residence, then it will qualify for what's called principal private residence relief, whereby there's no tax to pay. Incidentally, you wouldn't report your principal private residence disposal on your tax return either. So for non-residents, it's slightly different in that, whereas for a UK resident, you'd only report on these capital gains tax returns if there was a tax liability to pay, and only on residential property. For non-residents, regardless if for non-residents, I should say, the disposals occur, the reporting needs to be done under the capital gains tax return for not only residential property, but for commercial property, mixed use property, which could be a mix of both residential, commercial. For example, you've got a shop with some flats above it in a block, or where it says here rights to assets, where they're deriving 75% of the value from UK land. For example, if that individual owned land through maybe a limited company. And also, unlike UK residents, for non-residents, regardless of whether the disposal triggers a capital gain tax liability or not, that non-resident individual will still need to prepare a capital gains tax return. And it also applies for UK trusts and personal representatives. So for trusts, they'd also have to file their capital gains disposals through the capital gains tax return. And in order to do so, you'd need that trust UTR registration number to hand when we're creating a capital gains tax account. We'll get onto more of that later on. And if you're working, or if you're representing somebody, maybe a family member had recently passed away, and managing their estate or the affairs of their estate, then again, you would have to register any disposals in that tax year on the capital gains tax return. Now, the reporting requirements are now that, as we mentioned earlier, they have to be done within 30 days of sale completion, and also only tax paid within 30 days of sale completion. That is now normally done through an online process. So you'd have to register online. Again, we'll go on to that a little bit later. In some circumstances, they will allow a paper return to be filed, but it is very rare. So we commonly get some scenarios where we have joint ownership of a property. Now, what would happen is each individual would have to set up their own capital gains tax return account and file the return themselves individually, depending on their individual circumstances. So there could be a scenario, for example, where one individual doesn't have any tax to pay and therefore doesn't have to report that capital gain on their capital gains tax return. Whereas the other individual who owned a share of the same property, for them, it does trigger a tax liability, and therefore they would have to prepare a tax return, a capital gains tax return. So it does depend on your individual circumstances. So what steps do you need to take? So in order to report this correctly, you'd need to set up a CGT account online. In order to do that, with the CGT account online, it allows you to go back and look at previous disposals, and any subsequent disposals that you do have for that individual, they can be recorded through that CGT account. So how do we create an account for this individual? So the first thing to do would be to go to the link shown on the screen. The other way would be just through a simple Google search. You could pick up the same details there. You'll then be asked to provide a government gateway login. If you don't have a government gateway, then you need to create one. You can do one through the same portal. Now, if you're creating the government gateway account for the first time, you then need to link it to a telephone number, or mobile phone, I should say, or an email address, so they can contact you with authentication codes. And once you've got that government gateway set up and linked to some sort of contact detail, you'll then have to have your national insurance number ready, along with your name, date of birth. You'll then have to go through some sort of security check with HMRC, just to make sure that you are who you say you are. So you'd need 2 out of 3 forms of ID, or the 2 out of 3 security tests that they undertake, I should say. So you'd either need your passport with you, P60, or your credit history, that could ask questions around your credit history. So in the assumption that you've managed to create the account, you can then start filing the returns through your HMRC CGT account. If you're non-resident, for example, and you don't have an NI number, you'd have to enter your UTR number that you'd use for your self-assessment. And whilst you're filing the returns, it will give you the option here of whether you're filing the return for yourself or you're filing it for a trust or on behalf of someone else. So much like any other returns with HMRC, there's interest and penalties, and this is where it really comes into play in terms of not filing the returns on time. So there's penalties levied for not filing the return, firstly. Now, as we mentioned previously, the deadline for filing a return has been 30 days of sale completion. If the return is filed late, then HMRC minimum penalty is £100. They had previously mooted levying daily penalties, capping at a certain maximum of £900. That has since been scrapped, and the current position is that if anything is late by up to 6 months, return is filed late by up to 6 months, there'll be a £100 penalty to pay. Anything filed later between 6 to 12 months, then that £100 would increase to either £300 or 5% of the tax which is owing, whichever is the higher of the two. And the other thing just to bear in mind is that penalty just applies to the late filing of the return. There's also the tax which is due, which of course was due 30 days from sale completion. Now, if that's due late, or if that's paid late, then currently HMRC charge interest at that at 2.6% per annum. If you do have any queries, please don't hesitate to contact us. The email address and contact details are here, and we're more than happy to help. Thanks very much. Thanks for listening.